Hello everyone. Today we are going to learn the chapter 7 standard costing. Before starting, turn to page 129 in the Pearson Edexcel IAL Accounting Student Book 2, referring to the IAL Accounting Specification 2.5.1 to 2.5.6. Now we will see what we should know at the end of the lesson. Explain the purpose of standard costing. Describe the stages in establishing a standard costing system. Calculate the different variances and explain the reasons for variances. Explain the possible interrelationships between variances. Explain the principle of management by exception in variance analysis. Normally, we do plan or budget our future expenditure for any event, be it personal or business. And after actually incurring the expenditure, we always try to compare the budgeted costs with the actual costs. This is what we are learning in this lesson. A business sets a budget for materials for the coming month. After the end of the month, it discovers it spent more money on materials than it planned. What do you think is the cause of this difference? Could it be that the material was more expensive to purchase? Could it be that it had purchased more material than it planned to? Could it be a combination of the two reasons? Would the same apply to labor costs? A business would want to know the reasons for these differences. Can you think of any reasons why material and labor costs might differ from the plan? There will be many questions arising. We will be finding the answers throughout the lesson. A standard cost relates to the cost of one unit of production. Standard costing is a management technique that compares the actual cost of one unit of production with the standard cost. The differences of the standard and actual would then be analyzed and investigated, which is known as variance analysis. The purpose of standard costing is simply identified as assisting in setting budgets, evaluating business performance, controlling costs, allowing management by exception. Budget is a financial plan for a future period. The budgets are prepared using past information. This information is taken from the standards. The standards are targets by which actual performance is measured. Using the variance analysis, the business performance could be evaluated. The variances will identify whether the standards are overachieved or underachieved. Going with the findings, the necessary corrective measures would be taken to control the costs. Management by exception can be easily used with standard costing. This means that the management would only concentrate on the significantly higher variances, avoiding the smaller variances. When establishing a standard costing system, there is a process to be followed. First of all, collect the data and set the standard cost. Getting the correct standard is vital. Generally, two types of standards are available as ideal standard and attainable standard. Next is to wait till the actual costs are incurred. Afterwards, the standard cost can be compared with the actual cost. The comparison or variances can be seen in two types: total variances and subvariances. If the total variance is not clear enough, the subvariances may be calculated to get to the root of the variance. Next is to analyze the reasons for variances. This stage would enable the company to identify the causes for the variances. Identifying the causes would ultimately enable the company to take the appropriate action on each type of the costs. The first stage of any standard costing system is to set accurate costs for materials, labor, and overheads. To collect the required information on materials, the company would need to carefully examine the material specification. This will enable the company to identify the quantity required to produce one final output. Thereafter, the price at which the materials could be obtained. The trade discounts and any price increases must also be considered here. The company needs to collect the labor hours need to work and the labor rate. For the labor hours calculation, the quality of the materials will also matter. After obtaining the labor hours, the company can decide on the labor rate considering any overtime if requires. Overheads include fixed and variable, which needs to be looked into separately. The future increases in the rates can also be considered. Once the information for material, labor and overheads are being collected, it is possible to set a standard cost for 1 unit of production using the formula shown in the slide. Standard cost per unit equals to the addition of standard material cost per unit, standard labor cost per unit and standard overhead cost per unit. We will now look at an example on calculating the standard cost for 1 unit. A business manufactures handkerchiefs at its factory. The following budgeted information is available for March 2021. Budgeted output is 40,000 handkerchiefs. The standard cost information relating to one handkerchief is as follows. Material cutting time is 5 minutes and 10 minutes of sewing time is needed to complete. Labor is paid at the rate of 9.2 pounds per hour. Material usage including waste is 0.2 square meters per handkerchief. Material cost is 1.2 pounds per square meter. Fixed overheads are 22,000 pounds. Calculate the standard cost of one handkerchief. Now we will see how we can calculate the standard cost of one handkerchief using the given information. Remember, we can't get the standard cost directly. We have to go through few steps. Step 1 is to find the standard labor cost per unit. If you can see the information slide, the time is given separately. What we have to do here is to get the addition of the separate times given and convert them into hours to obtain the labor hours per unit. 5 plus 10, 15 is divided by 60 to convert into hours. This will be equal to 0.25 hours. Since we are given with the labor rate, now we can multiply the labor rate with the duration, labor hours, to calculate the standard labor cost. That is 0.25 hours into 9.2 pounds equals to 2.3 pounds. Step 2 is to calculate the standard material cost per unit. The standard material cost per unit can be found using the usage of the material per unit into the price. That is 0.2 square meters into 1.2 pounds equals to 0.24 pounds. Step 3 is to calculate the standard overhead cost. Here we have to use the total fixed overheads and the budgeted output. Fixed overheads divided by budgeted output, that is 22,000 pounds divided by 40,000 units, will calculate 2.55 pounds. Final step is to total up each element of the standard costs calculated above. Can you see the values in yellow color font? Those values are required to add up together to find the standard cost per handkerchief. That means 2.3 pounds plus 0.24 pounds plus 0.55 pounds equal to 3.09 pounds. Having set the standards and the way in which the budget is constructed, the next item to consider is the monitoring of results, which is done using variance analysis. Variance is the difference between the standard cost and the actual cost. Variances are not expressed as positive or negative numbers, but as favorable or adverse. Adverse variances, as a rule, an adverse variance means that we have spent more than the budget allowed. Actual costs are greater than budgeted costs. Let us look at a few specific examples and try to determine the reasons for the adverse variances. An adverse material usage variance can be brought about by the use of inferior raw material or poor training of staff. An adverse price variance may be because of a sudden price increase or the withdrawal of a supplier from the market. Adverse labor hour variances may be due to an unskilled person doing a job that requires more skill or a delay in getting the materials needed before the job can start. An adverse rate variance may arise because trade unions have increased pay rates after the budget was prepared or the wrong kind of labor was used for the job. It is not possible to list every single reason for adverse variances. However, by working through the many activities later, you will quickly come to identify additional causes. Favorable variances show that we have spent less than planned. Actual costs are lower than budgeted costs. Under favorable variances, there can also be a price variance, where materials were purchased at a better price, or where it was possible to use less skilled or cheaper labor than originally thought. The types of variances you will be learning are raw material variance, labor variance, and overhead variance. The overhead variance would be seen as fixed overhead variance and variable overhead variance. Raw material variances. These variances consist of the total variance, the usage variance, and the price variance. These can all be either favorable or adverse. The total direct material variance is the difference between the standard cost of the material and the actual cost of the material for the actual units produced. It is therefore made up of the sum of the two subvariances, the material usage variance and the material price variance. Rarely is the total variance the result of only one of the two subvariances. The material usage variance is the result of the difference between the quantity budgeted, the standard usage, and the actual quantity used. To determine the value of this variance, the difference between the two quantities is multiplied by the standard cost. That is, standard quantity minus actual quantity into standard price. The material price variance is brought up by a change in price. That variance, like all others, can be favorable or adverse. This can be calculated by standard price minus actual price multiplied by actual quantity. Labor variances. As was the case with material, there is more than one type of labor variance. The variances used are the total variance, the labor rate variance, the labor efficiency variance. The total labor variance is the difference between the standard labor cost and the actual labor cost for the actual units produced. It is made up of two subvariances, the labor rate variance and the labor efficiency variance. The rate at which labor is actually paid can vary from that budgeted for. A standard number of labor hours per item is also planned and budgeted for, but this too can vary. Think of the labor rate variance as the price of labor and labor efficiency as the quantity of labor. The labor rate variance is the difference between the rate in the budget and the rate paid. To calculate standard rate minus actual rate into actual hours. The labor efficiency variance is calculated standard hours minus actual hours multiplied by the standard rate. Overhead variances. The fixed overheads can also vary between the budget and the actual amount spent. In this case, there is only one variance that can be calculated, and this is the total fixed overhead variance. To calculate budgeted fixed overhead expenditure minus actual fixed overhead expenditure. In addition to the fixed overheads, there are also overhead costs that vary with the level of output. The variable overhead variance shows the difference between the amount of variable overhead that has actually been incurred and the budgeted variable overhead for the actual number of units produced, the level of production. The material price variance could result in either as a favorable variance or an adverse variance. Now let us understand the possible reasons for the variances. When the material price variance is favorable, it can be due to the lower prices charged by the supplier. This would enable the company to spend low costs on material. Bulk purchasing would make the prices lower, or else the trade discounts received by the supplier would lower the price than expected. If lower quality material is being purchased, the company would obtain the material at lower prices. The reasons for adverse variances would be the higher prices charged by suppliers. Better quality materials purchased would cost the company than they expected. If the company has a supply chain problem, they will lead to higher prices, which will create adverse variances. If the suppliers no more provide trade discounts, the company would not be able to enjoy lower prices. When the company has to spend more on carriage inwards, it will increase the cost on materials. Now we will look at the causes for the favorable variances of material usage variance. High quality materials would enable the company to get the maximum use of them with least wastage. If the company is strengthened with a high skilled labor force, the company will be able to get the best usage on materials. The improvements in production process would be obtaining the materials usage very well with less wastage. The causes of adverse variances on material usage can be seen in the second image. Using inferior materials would not enable the company to get the best usage, as such materials would have some or the other thing lacking. So, high wastage even though at a lower price. When the company has employed low skilled labor force, they would not use the materials properly, which would result in producing products which would be mostly rejected. If the company does not have a proper inventory controlling, the materials would not be used efficiently. There is a possibility of theft of inventory, which would lose the ability of the company to obtain the maximum usage of the materials. The reasons for labor rate variances can be identified as shown in the slide. The causes of favorable variances would be lower skilled workers used for production, which would cost the company less than employing higher skilled workers. If the company is required to pay less overtime and fewer bonus payments, the labor rate variance would be favorable. If the company experiences a reduction in the labor rates, it would be lower than the standard labor rate. The reasons for adverse variance can be identified. Increase in the labor rates would result in an adverse variance. The labor rate could be increased as a result of the government legislation, which is known as a national minimum wage. An unexpected overtime hours required to be worked would increase the overtime payment along with the labor rate. Higher skilled workforce would cost the company higher than hiring lower skilled workers. So the actual labor rate would be higher than the standard cost. If the company faces a shortage of skilled labor, the company would need to employ more workers, resulting in increased labor rates. Now we will learn the reasons for labor efficiency variance. Let's look at the possible causes for favorable variances. When the company has a higher skilled labor force, they will be completing tasks more quickly, which will consume less number of labor hours on the tasks. The company using better quality materials would enable the staff to make the production more efficient, could be due to less wastage. If the company is increasing the wage rate, the laborers would be motivated to work more efficiently. If the company could purchase new machinery, this would minimize the breakdowns and improve the efficiency in production. Next, we will look how the labor efficiency variance can be adverse. Now, low skilled workers would be less efficient, which would require more labor hours than expected. Low quality materials would result in high wastage, which would slow down the production. The shortages in the materials used would lead the workers being idle, which would reduce the efficiency. Poor training would not improve the skills of the staff. On the other hand, lack of supervision would lessen the efficient working hours with more idling time. The reasons for fixed overhead variances are now seen in the video. You will notice that the reasons for an adverse fixed overhead variance are the opposite of the reasons for a favorable fixed overhead variance. In the exam, you need to make sure what the question is asking. We will look at the causes for adverse variances. The causes of favorable variance would be the opposite of that. Increasing factory rent or rates would increase the fixed overhead actually incurred, causing an adverse variance. Increasing direct expense would directly affect the production level. The reducing production would adversely affect the fixed overhead variance. The adverse variance on the sales budget would lower the production of the company, resulting in an adverse fixed overhead variance. The machines with breakdowns would reduce the production level. In return, the fixed overhead variance would be adverse. The reasons for variable overhead variances could be identified as seen in the video. We will look at the causes of favorable variances, and the causes of adverse variances would be the opposite of favorable variance causes. Indirect materials being cheaper would create a favorable variance. Cheaper prices could be due to bulk buying. The indirect labor cost would be lower than planned. This could be due to a decrease in the national minimum wage rate than expected. Decreasing indirect expenses due to more efficient cost control. For an example, optimizing electricity consumption through the installation of energy efficient machinery. Interrelationships between variances. Variances should not be looked at in isolation. There is a relationship that exists between different variances, and it is important to recognize this interrelationship when analyzing the causes of variances and planning to take corrective action. The cause of a favorable variance might directly lead to an adverse variance elsewhere. For example, in the area of material price and material usage, if a business buys cheaper raw materials, this will lead to a favorable material price variance. However, this may not be beneficial to the business. The cheaper materials might lead to more wastage or scrap in the production process, and so lead to an adverse material usage variance. Also, it might lead to an adverse labor efficiency variance if production takes longer due to poorer quality material. Other interrelationships to consider: better quality materials might not only affect material usage but also labor variances. It might mean lower skilled and therefore less expensive employees can be used, resulting in a favorable labor rate variance. In addition, better quality materials might make the production process quicker, resulting in a favorable labor efficiency variance. A higher level of skilled labor may result in an adverse labor rate variance but a favorable labor efficiency variance. An adverse labor efficiency variance might lead to an adverse variable overhead variance if less skilled employees are less productive. When analyzing variances, it is always wise to look at all the information you have been provided with before coming to conclusions about the cause of the variation. Management by exception. This is a business technique for examining operational results and only reporting and acting on those issues that are important to the business. In terms of variance analysis, the aim of management by exception is to focus the attention of management on those variances that differ significantly from the standard. It is the larger, significant variances that should be carefully examined as to the reasons behind them. The business can then take the required actions to correct these because it understands that the scarce resources of the business are being targeted at the important issues. There are a number of benefits from using this approach. First, it focuses attention on the things that matter, resulting in better overall business performance. Second, it saves time. The quantity of information made available to managers is reduced, improving their efficiency. Third, it prevents managers from overmanaging their employees. However, there are also limitations to management by exception. Small variances might be ignored until they become critical, which could be prevented if action was taken earlier. It also relies heavily on the standard costs being accurate, otherwise there will be too many significant variances. The concept also tends to suggest that only managers can correct variances, which might demotivate staff. Finally, there is the problem that positive variances may be ignored by management when it might be possible to make further improvements, meaning that inefficiencies continue. A business budgets for a labour rate of £6 per hour. It also establishes that 60 hours are needed to complete the budgeted output. Therefore, the budget shows an amount of £360 for labour. The actual number of hours has decreased to 56 hours, but the rate was increased to £7 per hour. You are asked to calculate the total labour variance, the labour rate variance, and the labour efficiency variance. Okay, to calculate the total labour variance, we have to get the difference between the standard labour cost and the actual labour cost. £6 into 60 hours will give you the standard labour cost, and £7 into 56 hours will give you the actual labour cost. Therefore, £360 minus £392 will give you the difference of £32 adverse. To investigate this adverse variance, split it into two sections, that is the two subvariances of labour rate variance and labour efficiency variance. Labour rate variance is calculated using the difference between the standard rate and the actual rate multiplied to the actual hours. £6 and the £7, get the difference and multiply it with 60. You will get a variance of £60 adverse. Then the labour efficiency variance, get the difference of the standard hours and the actual hours, multiply it with the standard rate. So 60 hours and 56 hours, get the difference, multiply it with the £7. You will get a variance of £28 favourable. £60 adverse and £28 favourable gives a net £32 adverse, which is the same as the total variance calculated above. This is the summary of the lesson you have learned today. Go through the formulas again and learn them well. Here we are at the end of the video. Thank you for watching the video. Stay safe.